is Michael King. In this second video on financial statement analysis, we're going to look at valuation multiples. This is going to be section 4.7 from Booth, Cleary and Rakita. Valuation multiples are used by analysts to standardize how expensive or how cheap a company's stock is relative to its peers. So we're going to be standardizing price by earnings per share, maybe by book value per share, or we're going to standardize the total enterprise value, which is the value of all the assets, by EBITDA. We're looking at a company's own history over time, which is the trend. However, we may also look at multiples across companies at a given point in time, which is called comparable companies or trading multiples of comparable companies. All of these multiples take the same form. It's a form of payback. How long will it take to recover my price? Which is a shortcoming because you're only looking at 1 year of the financial metric, either the last 12 months or the next 12 months. Let's look at Apple and how their valuation multiples have changed over time from 2015 to 2019. Notice that there's a number of inputs we need to have: share price, shares outstanding. We're going to calculate book value per share, which is shareholders' equity divided by the shares outstanding. You're going to look up what their dividends per share, earnings per share are, and look at how much the dividend is as relative to the share price to get the dividend yield, as well as how much of the cash that a company is earning do they pay out in the form of dividends, which is the payout. These multiples that combine a market input, which is forward-looking, with a financial statement input, which is going to be historical or backward-looking. Price earnings multiple relates the share price to earnings per share, where earnings per share is simply net income divided by shares outstanding, either at the end of the year or you could use the average shares outstanding. Here we can see that for Apple, it's gone from a multiple of 11.5 times up to a multiple of 17.6 times. You can use either basic or diluted shares outstanding, and you will also find people using either a backward-looking or a forward-looking earnings per share. When it's backward-looking, they call it last 12 months or LTM. When it's forward-looking, you could use next 12 months or NTM. So the ratio itself is simply the share price divided by earnings per share. And if you multiply the top and the bottom by number of shares outstanding, you can see that it simply becomes the market capitalization of the company divided by its net income. Another metric is the market to book ratio, also called the price to book. Price to book is related to the book value per share, which is an accounting measure. It's simply the common equity of the firm on its balance sheet at year end, divided by the number of common shares outstanding. You can see that common equity is not the market value, it is the book value, and that it would include all the different categories shown on the balance sheet, which could be any of these: common stock, paid-in capital, retained earnings, or treasury stock. All you do is you take the share price divided by the book value per one share, or if you multiply the top and the bottom by number of shares outstanding, you could take the market capitalization and divide it by common equity. Notice that the price to book for Apple has gone from 5.2 times up to 10.7 times, showing that it has been increasing steadily. The other multiple we look at is enterprise value to EBITDA, where enterprise value is simply the market value of the assets. To find the market value of the assets, we're going to have to use this calculation here. It's going to be market value of equity plus the market value of debt plus the market value of preferred shares. You're going to add non-controlling interest, and you're going to subtract any excess cash to get enterprise value, which may be called total enterprise value, or TEV. And what we're going to do is we're going to relate this value of all the assets to the cash flow, some metric cash flow generated by the assets. We're going to use a financial analyst measure called EBITDA, which is not an accounting measure, where EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This is a shortcut for free cash flow, but notice it does not take into account capital expenditures, which are a use of cash. You can see here that the EV to EBITDA multiple for Apple has gone from 5.7 times up to 11.4 times, and you can see the trend is upward over time. That's it. Thanks for your time.